Hi, folks. My name is Pat Gage, and I'd like to just go over what we're going to cover tonight. We're going to cover multifamily and syndication. This is going to be a 5,000 foot level view of this. This is not by any means, anything down deep in the weeds. This is an overview. So, with that, let's get going. So, what are we talking about tonight, folks? Well, we're talking about commercial real estate, i.e., mostly multifamily or apartment building investing. We're going to show you and illustrate to you how typical investor returns can range from 6% to 12% or more annualized, and that's calculated against the money that is already invested in the property. We're going to show you how you can invest in commercial real estate with no tenants, no toilets. That means you can do this without any tenants and toilets or collecting rent from the tenants or anything like that. We're going to show you how to enjoy a more financially beneficial lifestyle. Okay, we're going to show you how that is doable. So what we're going to learn is several different things. We're going to learn the big why we need to do this and some of the how. Some of the how to do this and how to live a better life. We're also going to introduce you to the $2 trillion plus U.S. multifamily market. We're going to give you some ideas about what's going on in there. We're going to talk about the latest trends in the multifamily business that are driving the expansion growth and the reason why we see this as an awesome area to get investing in and why we are investing in it. Explain how groups of investors such as you, people just like you on this call, can buy these type of properties in what is called a syndication, and we'll talk about that and cover that in a little bit of detail as well. And then we're going to give you the top reasons why we invest in multifamily as well as other people. The top reasons why this is such a good asset class to be in, and at any level for any investor. And then we're going to take, round things out with kind of a life cycle of a multifamily project, which also extends to any really commercial project, self-storage or multifamily or mobile home parks. Kind of the same process that we follow. And again, this is at a 5,000 foot level, folks. This is not, nitty gritty. So, don't worry about that. We have other videos and other stuff trainings we can give you on that. But here at first we got to say this, and this is our disclaimer, which we always have to say, right? In today's litigious society, I'm not a broker, I'm not a realtor, I'm not a lawyer, I'm not an accountant, I'm not a CPA, I'm none of that. What we're going to discuss in this is purely for educational purposes. We are not investment advisors, and this webinar is not provided for, financial advice. This is for educational purposes only. All investments involve some degree of risk. You should be aware of your risks, tolerance levels, and financial situations at all time. Run your budget. Don't give me your last 20 bucks, is basically what it says, and I'm not looking for your last $20. Read all investment documents carefully before making any investment decisions. Also, all information should be researched prior to any money invested. You are free to accept or reject all investment recommendations we make to you here on this platform or going forward. All services we offer are subject to market risk and may result in loss of your investment. As you know, a recommendation is not a guarantee for the successful performance of an investment, and we cannot guarantee anything even against losses arising from market conditions. All right, so that's kind of our disclaimer. And we do not invest your money, or I should say, do not invest your money on our recommendations alone, on this webinar alone. Consult your professional advisors. All right, and we have a lot of clients that we've talked to their accountants, their lawyers, all these sort of things, and we walk them through if we have to. So that's our disclaimer, and then let's get started. So who am I? Who's the guy talking? Right there, I am right there. I'm just an ordinary guy, folks. I've been doing real estate investing for over 25 years. I've bought and sold a lot of properties. I've had a retail strip center. I've owned a couple different billboards around town here. And yes, you can buy billboards. And also, I've owned several hundred single family homes. That was the largest part of our portfolio, was single family leased to own properties. So we've done a lot of different things in this real estate realm. I got it piece by piece. I put it together, talked with people, got some mentors, listened to experts, and just went out there and did things and got it going, because that's really what you have to do. And the biggest thing is I made mistakes. I can tell you I lost money. And I think that's made me a better investor today, with doing what we're doing. I have also used private money or OPM or syndications. I couldn't have bought the billboard unless I had other investors. I couldn't have bought the strip center without other investors. So I know what I'm talking about on that angle because I've done this before. We used to call it private money. Now the catchphrase is syndication. And it just basically it's a key word that they're using today. So now why else should you listen to me? Is I also develop a course about 10 steps to money. It was a business credit, how to raise money for your business, on your business. And I was able to joint venture and be partners with Ron the Grand. That gentleman is right there, the godfather of real estate. And not only that, I spoke on his stages. I was able to speak at the Learning Annex in New York City, which I was very, very grateful to do, and shared my message with us. And as well as I work with other mentors, that gentleman right there is Alan Coggill, one of the leading experts in the private lending, private money space. His website is Private Money Made Easy, Private Lending Made Easy. Alan's an awesome guy. Spoke at his events too, and he's really kind of got me, and I used his system. I use his system to go raise private money. I did luncheons like he tells you to do and stuff like that. So having those type of mentors and those people that I can bounce ideas off of has helped me as well. And then with that success in my speaking, I was able to be on radio shows across the country as well as here locally at WCHB AM here in Detroit. I don't do this to brag, and I don't do this to tell you what I've done. I'm just telling you this is my experience, and this is the kind of experience I bring to this type of business. So, why are you here? What drew you to this webinar? Why are you here? Did somebody send the link to you and you said, okay, look at this or whatever? Well, let me tell you one thing here, folks. If you're here to buy commercial real estate, you're in the wrong spot. Okay, let me get that right. We're not selling anything, and that we're not selling anything. When I mean that, I say that we mean it. I'm not selling anything. But folks, if you're here to learn how to purchase commercial real estate or CRE by using syndication, you're in the right spot. I'm going to give you an overview, and again, like I said earlier in the presentation, this is not a drill down. This is a 5,000 foot level to give you a taste of what syndication and multifamily investing is, folks. But you're in the right spot if you want to start your educational process. You're in the right spot, because really, folks, let's take a look at it from this way: buying a 10-unit complex or a 200-unit apartment complex, the principles and steps are all the same. And they really are. They really are. The larger you go, the easier it gets. But that's really as simple as it gets, folks. So why am I here? Well, I'm looking for people who want to partner with me on multifamily opportunities. Right off the bat. Right there, folks. That's what I'm here. I'm looking for people who want to be and have a more stable financial future. Because, folks, I'm telling you, with what's going on in the world today, and finances, and people clinging to their 401ks, and I just heard a statistic yesterday about people who retire, and this is from the federal, or yesterday, U.S. Census Bureau. They say out of the last 40 years, 9 out of 10 people who retired into poverty. 9 out of 10 people who retired in the last 40 years, they did a study, and this is what happened: is that they retired and they instantly went into poverty status. So I'm also looking for people who want better than that. Okay, I want people who have IRA accounts and retirement accounts and savings account, and that are not returning at least the rate of inflation. Okay, to take this message in, and the rate of inflation is 2.2% as of the end of fourth quarter last year. So if your investments are not returning you at least 2.2. Well, it's got to be more than 2.2 because that's the inflation. Now, inflation is the inflation you pay for goods. So if your savings account is not turning you 2.2%, which none of them are, I can tell you that right now. None of you on this call are getting that in savings, but that's why you're here, right? You're looking for something different. You're looking for something better, okay? Because here's what I know, folks. Nobody takes down a 200 unit apartment complex alone, okay? And you need a team, right? You need people to be with you on this journey. Now, there's several different levels of investing. I'm an active investor. I'm a syndicator. I'm in the deal. I'm running the numbers, crunching the. That does not mean you have to be doing that. In fact, we'd rather not have you be doing that. If you have money in an IRA and want to be what they call a passive investor, and you pass the criteria for that, fantastic. You don't need to know this business to invest in this business. That's the beauty of this model, folks. So because really, we all have to start somewhere, right? We all have to start somewhere. So what I'd like to do tonight is consider this your start or your beginning. This is the start of the beginning of your financial education. And again, folks, do not get over stressed about this. Please take this as step one of a long journey. We're always learning. Trust me, I learn stuff every day. So let's talk about the big hows, or I should say the whys and the how. Going back to a couple slides saying that if you don't have at least the rate of inflation that you're making, you know we have to show you why you must expand your portfolio beyond stocks, bonds, and IRAs. Let's take a look at stocks. Let's take a look at bonds. Are they making over 2%? If they're making 2%, if inflation's 2.2%, so you're negative, right? So that's why you must expand this, and this is what hopefully we're going to do in this presentation is expand your mind and your learning, and then why you must seek higher yielding investments to be financially free, to eventually not only financially free, folks, but financially stable when you retire or when that income stops coming in. It's not a matter of being financially free, it's a matter of having stability. And how you can invest, people on this call can invest in commercial real estate passively to gain that higher yield. You don't need to have tenants and toilets. You don't need to rehab and be flipping. You're not going to go down to the property and collect rent check. You're not going to go down and receive, phone calls in the middle of the night because the toilets are overflowing. You're not going to do any of that. That's what they mean by passive. You're just not going to be able to do that, and we don't want you to. Okay, so we're looking for that. Now, let me take a look and give you some realities here, folks. I've given you one here about as far as the inflation rate. The realities that make seeking higher yielding investments what you have to do. One is life expectancy, folks. People are living longer, aren't they? Let's take a little bit back journey in history here, right? Let's talk about the Social Security system, right? Everybody says it's broke, it's going broke, it's this and that. That was designed in the 1900s, right? That was designed way back when the government was young. So in the 1900s, you worked till you died, right? Which is probably less than 50 years old, right? So the Social Security system worked. 55 was retirement age. Okay, fine. We only had to pay out a few people, and the lucky ones went on and had money in there. That's great. But now we go on to move up a couple decades. Now we're in the 1960s, right? Now your retirement had to last only a few years because people again with advances in medicine and foods, people were living a little bit longer, right? You retired at 55, 69 or so. You made it till okay, retirement had to last a little bit, and that was definitely obtainable, right? That was definitely obtainable because back then in the 60s you got a pension, you got a retirement fund, everything. My father is one of those, and he's still living at 86 years old. He has his retirement, he has his pension, he's doing great. He is doing fantastic, and he's able to go and do what he needs to do. He doesn't have to rely on anybody, right? Now, but the next reality, folks, is today guess what happened, right? Today we're all living longer, right? We may be retiring that, but now what are we doing? We're living into the 70s and 80s. Let's take a look at my father. If you don't have anything set aside, folks, your retirement's going to run out, even if you have a retirement. If you're of my age here, I don't have a retirement. I don't have any set retirement from any one company. I did work at Ford way, way long time ago, but that was minimal, okay? But that's what happened, and they've changed the retirement IRA account since then. So that's the real big life expectancy reality. Another reality, folks, healthcare. Healthcare costs are going up. Okay, let's take a look at this chart here. Healthcare CPI is growing faster than the CPI, or the Consumer Price Index. If you look down here in the corner, and the latest data is 2015, it was 2.8%. That's how the cost of raising that. What did I just say inflation was? 2.2? You add another 2.2, 2.8 on that, you're already negative, right? The cost of healthcare is going up, right? Everything costs more money now. Talking to your doctor, talking to your pharmacist, and we all know this, and I'm not going to blame it. So that's another reality. That's another reason why you need to be looking for investments that yield higher returns, and they're not going to be found at your Raymond James or your Merrill Lynch. It's not going to happen down there. It's not going to happen on Wall Street with your stock market, folks. Let's take a look at another one, folks. The stock market returns. Let's take a look at those. Are way too low. Let's take a look at an actual growth over the last 15 years. Let's take a look of a stock, okay, purchased. If you did, bottom line, if you invested $1 in the stock market in January 2002 and left it in there 17 years and adjusted that for inflation, your dollar would grow to $2.30 in 15 years when adjusted for inflation. Now some of you think, oh my God, that's great. Yeah, but the thing is, that's $1 and it only went up $1.30. How much money would you have to put back in year 2002 to have financial freedom today? A lot more than $1. That's a lot. I mean, that's just yes, okay. It grew $1.30, but that's 15 years, folks. In a couple slides, I'll show you how you can quadruple that, and that's what people do. Okay, that's what people do in this environment. But that's a reality there too. Stock returns are way too low for that. So, how can you get ahead? How do you take this information I just put on your shoulders and said, okay, go? How do you do that? How do we do this? Well, the magic really is the compounding returns. And I'm sure you've heard that mentioned somewhere in today. Obviously, it's not in from your, Merrill Lynch guy. So you have to compounding return and add investments with a potential higher yield to your portfolio. Like we talked about earlier, the math shows this astounding difference, folks. Let's say if you took and invested $100 for 30 years at different interest rates. All right, and this chart's going to show you the difference here. Let's take a look at this. Let's say $100, and let's take the first green bar there, the 182. You have 2% return, which maybe some of you had or still have in your account. At 30 years, at $100 turns into 182. Horrible, right? My God, that's crazy. Let's take a look at the red line. Now that $100 at 10%, wow, that returns $1,900. That's pretty good, right? That's doing good, right? That's beating the inflation, right? But let's take a look at the last line or last bar there, folks. $100 at 18% return returns you $21,270 in 30 years. And I can tell you right now, folks, there's people doing this every day, 18% or higher every day. And don't think it's just the people like the Gateses and the Kennedys. And there's not, folks. There's common people just like you that are making those type of returns. Those returns are pretty average and pretty expected. Okay, but look at the difference in what you're going to have to do. Now, let's take a look at this. Let's reverse engineer this, right? Let's take a look at this. And this is good. This is great. Let you say, okay, cool. I'm getting 2% on my bonds. I'm happy. Okay, great. Let's take a look at from the reverse, right? How much money are you going to have to retire, right? Every month. Let's work it backwards, right? Again, doing the law of compounding returns, adding some math in here, okay? Let's say that you're going to need $15,000 a month in passive income when you retire. 20 years from today, let's say you're 20-year-old or a 40-year-old or 50-year-old, whatever it is, you need $15,000 a month to live on, right? So how much do you think you need to save every month to get to that, right? Let's take a look at this. And these numbers are going to astound you, folks. Let's take a look at the same bar. Okay, folks? Let's take a look at now what happens? It reverses, doesn't it? At 18%, okay, you're only going to have to save $433. I know everybody on this phone call can save that much a month. Heck, cut out your lattes at Starbucks and you can put that in there, right? But what I want you to show and what I want to demonstrate and illustrate to you is that it's not that much when the yields are higher. If you're sticking with your bonds, your IRAs at 2% or negative in your savings account, you're never going to get anywhere. Let's look at the next bar, the red bar. Now at 10%, okay, $23.70 per month. That's probably getting a little tighter for everybody, right? It's a little tight to put that away. But let's look at the bottom line, folks. Let's look at the bottom line. If you keep doing what you're doing right now, you're going to have to save $30,530 a month so you can live at $15,000 a month at 2%. I know that there's nobody in this call can put that kind of cash away per month, or you wouldn't be on this call. I know that for a fact. And if there is somebody in this call, love to talk to you, okay? But I can guarantee there's not. But if you notice the higher yielding events or opportunities are the way to go, aren't there? Even if you get one at the red or the 2,000 or the 10%, think about that's doable. That's probably a push for most people on this phone call, but it's a little bit more attainable, right? We have to cut out some stuff, eating out, maybe, not feeding the kids, I'm just kidding. Okay, I'm just kidding. But I mean, think about it. But most people are on this blue line here, folks. Then it's just unobtainable. There's just no way to do it, right? What I'm going to introduce you to right now is, again, multifamily. Let's take a look at what the definition of multifamily is. The definition of multifamily is generally 5 units or more. Okay, and you can see some of the pictures down here below. And the reason it starts at 5 is because 1 to 4 units is considered residential real estate or residential property, and that doesn't give us the tax benefits and the other benefits I'm going to talk about here in a couple seconds. So it's 5 units or more that is reach that kind of multifamily. Now it reaches true economic scales at about 150 units and above. Again, bigger is better. It's the same here in multifamily. So now how are multifamily properties valued compared to residential? Well, they're valued not on comparables, not on this. They're valued based on their net operating income, or NOI. And again, folks, you don't need to know how this is calculated. I'm just showing you how this is done. So don't fret. You can take notes if you want to, but anyway, let's take an example of a 200 unit complex, which is very typical of what's out there. Our team is able, so when we purchase a property, we purchase properties that need some kind of deferred maintenance, that are not run very well, not managed well, the rents are low, maybe some bad tenants here and there, and again, we get those people out and do some fixing up. So that's what we talk about here. So let's say we're able in this 200 unit property to raise the rents $25 a month. Now for a typical tenant, that's no big deal, right? Okay, but again, we're spreading this over 200 units, right? So here's some calculations. So how you do this and how we value this is the middle formula there: 200 units times a $25 rent increase times 12 months. So over a year, we're going to get that much increase in the property. Now, the cap rate, or the 8% cap rate, is how we value properties. Again, I don't expect you to know a lot about this, but this is just a 500-foot level of how we value properties. So commercial properties, or I should say multifamilies, are based on cap rate, or the capitalization rate, the rate of return for that asset. It's really the risk in that. So with the higher the cap rate, 8, 9, 10, the riskier the investment. Okay, so we like to buy in the 7, 8, 9, and 10 caps, which means there's something wrong with the property. We're not buying the shiny penny. But let me take it back to this example. If I just raise rents for $25 in these 20 units, the increase to the value of that property is $750,000. Think about that, folks. I did a $25 rent increase over 200 people, and the value of that property went up $750,000. There's no other property. Residential, you can't do that because you got one tenant. You may have four tenants. Okay, you raise the rent over four people. Ooh, woo. And again, those are based on comps. Again, this is quick math. Please don't get bogged down in it, but just know the fact that when you do small adjustments in multifamily and commercial properties, okay, it is huge on the other end. And this is typical of what's going on in commercial real estate now. Now, another reality, or I should say another benefit of multifamily, is commercial loans. And again, that 5 units and up, you're in the commercial space. Multifamily loans are based on the property's income, like I said before, and occupancy. It's not on the investor's credit. It's not the investor's, comparables. It's not on his income. It's not on your income if you join the syndicate. They're not going to check your credit report. They don't check my credit report when we do commercial loans. Lenders scrutinize each property in great detail. And again, the property itself, not the investor. Okay, that's the biggest difference in commercial real estate and also multifamily. They look at the property. What's the NOI of the property? What are the expenses of the property? What is the price per unit? What is the repairs we're going to need? All that kind of stuff. So that's a huge benefit of multifamily right there. So now let's take a look at, now we've kind of discussed the cap rate and how we adjust and reposition a property a little bit. We talk about the loans. Let's talk about how we find these properties, right? Now, we do market cycles in emerging markets, which is taught by Dave Lindahl, but we go a couple steps deeper than Dave has gone. But basically, real estate's a cycle. And I'm sure you've heard that there's an up cycle and a down cycle, and there's a seller stage one, a buyer stage two, buyer stage one. These are all just names for what's going on in the market and stuff like that. But what we do to find areas is we do, again, demographics. We look at several different sources to give us demographics of, are people moving to that state? Are they moving to that county? Are they moving to that city? Is the income of the people in that area going up? Is it going up? Is there more than one employer in that town? We do not pick towns and cities and states that have one employer. Moving statistics, we look at that as well, as far as, are people moving U-Haul or not art van, van lines. We look at those statistics too. So we do a lot of data to get us into the states that we're in right now, and then we take that data down to the county, then we take it down to the city, and then we go to the towns, and because you can have a fantastic, okay, everybody's moving to Florida, right? But now every place in Florida is going up, and it's not. Okay, there's only several cities that are going up within Florida. You need to know that. And then within those cities, there's places that are doing good and not doing good, right? So we use a lot of that to find and pick the cities that we're in and the towns that we're in right now. Okay, so If this all sounds good to you, I'll continue on, and please keep your questions to the end here. But so, how long do we invest for? All right, and this is the great question I get. Well, God, I really want to get into this. I want to do this. Typically, how long do you invest for? Well, again, like I explained to you earlier in this, we're not flippers. We don't buy these like you would a house and fix them up, and 90 days later, we flip it. Typical investment is 2 to 7 years. And that's very common because we're not in the flipping business. So we're looking at what we call repositioning. That's an industry keyword there. The business or the property, and it really is a business. So we don't fix them up and flip them like that. We hold them for 2 to 7 years, and depending right around the 5 year mark, we look at either refinancing the property or possible sale at that time. So what we have done in the past is right around the 5 year mark is the time to refinance the property because the interest rates have been very, very favorable. Get most of the investors' money out and return that to them, and then we just keep the property chugging along the way it is, and in a better position, and raise the rents and keep going on with our plan. So that's typically what we do. Now, why is multifamily values less volatile, like this little guy here surfing, than single family? Well, I mean, I've already kind of gave you the clue in the slide earlier. Is again, it is because it's based on the NOI of the property. You can have two apartment buildings sitting side by side of each other, and one could be valued at 1 million, and the next door neighbor one, same number of units, same building, can be valued at 500,000. Why? Bad management on the one on the other side that's only 500,000, bad tenants, bad processes, expenses out of control. NOI is nowhere, and again, the income in the property dictates what that property is worth. So, but you talk about residential real estate, you're pretty much capped what that neighborhood is. What the last house, within a mile radius that the realtor brings to you and says, well, that's a comp. It's the same square footage, same bedrooms, baths, and garage. The comp's out at 210. That's what your house is, unless your house has got, marble statues in it. And realistically, people won't pay extra. But that's the value. So, and again, another thing is too, multifamily is people need a place to live, whether it's a good time or bad time. And yes, you can say that for residential, but rents don't you typically fluctuate as great as they do in residential, because again, residential property, you have a lot bigger pool of people that to pull from. So where in an apartment, the rents don't really fluctuate. They stay with the market. So that's a real good plus for the multifamily investor and for how we do business in here. So now I'm going to talk about how we classify, or how the industry classifies, multifamily. Now, we classify the properties as Class A, Class B, and Class C. And this is for all commercial properties, are classified this way. Now, A class is obviously new construction, recently remodeled. It got the top amenities. We got a high income tenants, low vacancy rates. These are the shiny pennies, right? These are the ones in the hip, cool places in town. Everybody drives by them. They're lifestyle luxury. They're great locations. And that's a Class A building. We don't invest in that because obviously there's nothing really kind of for us to do to up the value of that property, because usually those are brand new constructed within the last year or whatever. So the Class B is the next one. Now these are a little older properties. They've been around, and they're not recently remodeled. They got fewer or no added amenities. They may not have a clubhouse, or they have a gym, but it's, an old exercise bike from the 50s. These are middle income tenants, decent condition. They have a value add investment opportunity, and that's what we look for. And that's really kind of just, it needs a little polishing, right? It probably needs a little polish on that job to make it look better. The owners probably owned it for several years, decades possibly. They're just tired. It's got some deferred maintenance issues, but generally well maintained. Okay, and you probably have seen those, and that looks nice. That's great, and that's the area we invest in, is Class B and Class C, C plus area. Now you get down to the Class C properties. Now these are really older properties. These are properties built in the 60s, maybe even early 55, 60s. They need infrastructure improvements. They don't have that pool. They don't have that tennis court. These are typical lower income tenants. Nothing wrong with that. These have usually longer vacancies, because in that area that people tend not to move into those areas, because again, they're older properties. They don't have the amenities that they want to, and some of them are in less desirable locations. We go with Class C, C plus to B areas. Now there is two more here. There's a Class D and a war zone classification, which you don't want to go in, and I won't spare the words to talk about them, okay? So, what are some of the downsides of investing? We've talked about all the bonuses and the pluses. This is great. This is why. Here's the different classes. And again, this presentation is meant for a broad overview. I don't expect you to all grasp all this stuff. I just wanted to grasp the key points here. So, some of the downsides of this are, commercial real estate is kind of illiquid. Right? It takes time to purchase. It's a bigger purchase than a single family home. So it is a little very illiquid. To sell a property, it's you just can't put a for sale sign out tomorrow and have a contract and close in 30 days. That's typically not what happens. When you invest in these, you have a lack of control over the management of it, because you must trust others, and you must trust us, and then we must in turn trust the property managers. We don't self-manage. We have managers run it. Professional management teams run our properties, so we manage the managers. So that is that's a little challenge there as well. Another one is it's just really kind of harder to use a 1031 exchange vehicle to purchase, because what we're doing is, air quotes, pooling other people's money. But we can still look into doing it, but it is a lot easier in residential, because residential, usually if you're doing a 1031 exchange, you're buying the whole thing. All right, that's really kind of what it is. And then another downside is there's fewer buyers than residential real estate. Okay, I mean, this is a different game. This is what the quote unquote, air quotes again, big boys game. But there's fewer buyers than you would have for residential family houses that 99% of the population can buy, right? But that's okay. And again, what I'm doing with this presentation, folks, is giving you all sides of this multifamily cube. Okay. So now what I want to talk about is some of the trends that we see, and the reason why we like multifamily the way we do. And these are the trends that we see that are giving support to that multifamily investment. So let's take a look at this. Fundamental change here, folks, and there's several of them here, but one is rent is the new buy. Okay, and this is according to the Association of Realtors. There's 5 to 6 million new renters in the next 10 years. That means that people are not going and buying properties, okay, for one reason or another, and I'll cover that here in a few minutes. But rent is the new buy. People would rather rent a cool apartment than go buy a house. Lending has been an issue as well. Now I hear that restrictions on that are loosening up. But again, we've got renters for the next 10 years. Another trend that we see coming is that driving is the term demand for properties, right? Ownership isn't in the cards, right? People don't want to own a property, right? They figured, what, I liked owning or leasing or renting a property, even if it's a condo. They're not buying homes in the way they used to. Apartment dwellers there in the bottom, they 49% said, I may buy in the next 5 years, but that's huge compared to previous let's say my parents' age, everybody bought a home. If you didn't own a home, what do you mean you don't own a home? Nowadays, you rent an apartment, it's the new in, right? So ownership is not on the cards. People went to apartments when my father age, and then they got bought a home right away when they got their first job. That's just not happening. Another trend that we see coming is, renters are liking the freedom of renting lifestyle. It's really kind of a lifestyle choice, right? People like the fact of just paying. You're going to pay anybody. You're going to pay the mortgage company. You're going to pay the landlord. It really doesn't matter to them. But it's a lifestyle choice, right? They want to live in these cool areas or these downtown urban areas, or maybe out in the suburbs, and they don't want to take care of the grass and mow this and waste all that time. But that's a great trend for us, right? For multifamily investors. So that's another trend. And now the next trend I'm going to show you here is, you know, the millennials. And we've talked to, I'm sure you've heard this. Here's a chart from Travalia. Is, millennials are not buying homes at the same rate as previous generations. Look at the dip in that chart starting in 2005. People just are not going and buying homes like they used to. Now, that could be possibly because of the Great Recession of 208. Okay, whatever, but it still benefits us as apartment investors, right, and apartment owners. Of course, it does. Another trend that we see here, folks, is baby boomers are downsizing to urban apartments. They're going into urban apartments compared to, or releasing those homes. A lot of people in the baby boom, they downsize, right? They figured, I don't want to buy another house. So what do? They go buy in these cool A minus or even B type properties in these cities. Boom, they're buying those instead of buying another smaller house because they want to travel. They want to have time with their kids. They want to take those cruises they've talked about and whatever. So those are just some of the trends that we see that are out there that are moving this investment in multifamily or apartments. So we see the trend as an opportunity. As we see these trends as indicate that multifamily has a long runway. Okay, folks, a long, long runway in front of it. And, now, how do you benefit from these trends? How do we all benefit, right? Well, we do that, what we call buying together in a syndication. That's what this whole presentation is about, folks. It's how groups of investors can buy multifamily complexes, right? Now what I'm going to do is I'm going to cover the concept of a syndication. And again, folks, this is not meant to take this and go run into a syndication. This is a start, a beginning. This is kind of an educational start for you. This is the 55,000 foot level view of what a syndication is. So let's get started with that. So, what's the concept of syndication? Okay, well, multifamily complexes are expensive, and they're commonly purchased by a group or a pool of investors using a mechanism called a syndication. Now, the syndication rules are governed by the SEC, okay, the Securities and Exchange Commission of the United States. So we're not out here being cowboys, okay? There is rules and laws that we have to follow. I know a little bit of those laws and rules, but my SEC attorney that we hire to do all this for us is the person that knows everything. And that's a part of our team, and I'll explain that here in a few seconds. So let's take a look at the overall overview of this. The syndicator, which is us, offers an opportunity to their pre-screened investors, which would be you if you decide to move forward. And you can choose or not to invest in it. Okay, the syndicator, we find the property, we market to the ads, we perform all the due diligence, we have all the paperwork created by, again, as I said, the SEC attorney. We don't do any of that. If this is a go and we're going to purchase this, then another attorney would collect the funds from the investors, and that's typically wired to their escrow account or to the title company's escrow account. and then we manage the property until we sell, like we talked about. And again, folks, there's several steps in each one of these bullet points here. So I'm giving you just a really 5,000 foot overview here, folks. This is not in detail. And if you decide to move forward and want this, I'll show you how you can contact me, and we can go deeper with this. Okay, individuals are definitely can do this. Self-directed IRAs, family trust or entities, Incs and LLCs, invest in varying amounts and receive a proportional equity share of the cash flow and equity of the property. And again, I'm getting a little detailed, but I'm just going to say that if you have a trust or you an LLC, you can invest with that, okay? Because we invest in an LLC, and then the LLC invests in the properties LLC. That's how it works. Nothing is in your own name. You're not Bob Smith owning, the 200 units on 127 Main Street. That just isn't how it is, okay? So why do you want to invest in multifamily, right? And I'm kind of giving you a real, 5,000 foot level of this. So why do we want to invest in multifamily, right? Why are we picking multifamily for this type of investment? Number one is the cash flow, folks. Multifamily properties generate enough income to cover the cost of operations, capital improvements, meaning replacing roofs, paying the debt and mortgage on the property, and the remainder goes into the investor's pockets as far as a distribution. Okay. While the exact return will depend on the property you invest in, and double digit annual returns are very common. And that's what we're seeing, that's what we're doing, and that's how this business is run. So one is the cash flow, is that's really what it is. Another thing that we like, and we've already touched on this a little bit, is as far as investing in a property that may have needs a little shining, right? Needs a little polishing, and that value add. And we call it what we call as a forced appreciation. Forced appreciation is basically something that needs a little bit of buffing up, increasing the rents. We see the biggest jump in appreciation in just managing the property or asset correctly. We may be taking it over for an owner who's owned it for 10 years or 20 years and just tired, and just having policies on late fees and renewing leases, and just basically maybe just advertising. Multifamily values are based on their net income. Again, we can do that. So optimizing management and reducing expenses gives us a very good return. And again, going back to that example I showed you, where just a $25 rent increase at an 8 cap cruises to $750,000 increase. I mean, that's huge. And then we talk about fixing and upgrading units, which we really kind of didn't touch on, while you can increase rents huge. And $25 that's pretty low on the spectrum of what we're seeing out there in the industry right now. There's people that are redoing, these properties and doing $150 a month rent increases. So, I mean, you can just imagine what that does to your property, right? So again, that's another reason why we love multifamily investing. Another one is professionally managed, right? We manage the managers, right? In commercial real estate, we manage the managers. I don't go down and collect rent checks. I don't do that. We work with a property manager who is on the ground in that neighborhood, does this on a daily basis, and does that for us. Okay, that's how we do it. And the vast majority of residential investments, you can't do that. You very rarely have, unless you have a huge portfolio, that you're able to do this in residential. So that's a very big benefit right there, and it requires a lot more time and effort in residential. So now, why we another one? Well, we like the inflation in protection, right? We talked about that earlier. Inflation is 2.2% right now as of end of last quarter last year. Multifamily is one of the best mechanisms to avoid the impacts of inflation, right? The value of these assets will increase with inflation, thus becoming protected by the impacts of inflation. Real cash will decrease in value from inflation, right? That's why when Rich Dad Savers or Losers, he's correct. That $1 today with 2% inflation doesn't purchase the same thing. But if you notice that if I do a 25% rent increase on a property, I can hugely impact the value of that property. So now a property I bought for $1 million is now worth $1,750,000. That's huge, folks. But it's an inflation impression because, again, people have got a place to live. They have to have a place to live, right? This is not a, luxury thing. This is not a, oh, I can have it or not. This is not like a pool or a spa or, a tennis court, okay? Or even, membership to a country club. This is, people got to work to live, right? And at the time when the Fed is printing more money every day, owning commercial real estate such as multifamily properties is a great inflation hedge. It is. So that's another reason why we like investing and why you should invest in multifamily properties. Okay, let's take a look at, I guess, one more here: tax benefits, what we call depreciation, right? Again, kind of going back to the whole thing of multifamily. Commercial property investors are able to take advantage of depreciation on the building, meaning writing off the asset is depreciating over its lifetime or giving tax benefits, and you're able to write that off against the income of the property. And again, see your tax advisor for this. And again, when you invest with us in a property, we'll explain this, but we'll also tell you, go talk to your tax advisor on this. Basic, what this does is we're able to write off a portion of the property over a 7-10 year period against the cash flow that you're given. Okay, and again, that's all I can say because obviously we're not here to teach you about this, but again, it's just another benefit to do this. So now we've given you the idea here just in the last few seconds or few slides here of why we like this. So let's take a look at the top reasons that multifamily is the best investment right now to put your money into, and why we're going that direction as well. Okay, some of the top reasons is economics of scale, and we've kind of touched on this before. Economics of scale. We can have 200 people under one roof. So if one roof goes bad, we just protect 200 people. We're not replacing 200 roofs, okay? Commercial, they're a huge economics of scale. Vacancy rates is another one, folks. Is two people move out of a 200 unit apartment complex, we're not running to the bank waiting for them to foreclose on us because we have no money. It's not that big a deal. I mean, it impacts us, but it's not huge. You have that problem in 2 single family homes. You're stroking a check for the mortgages. You're stroking a check for the utilities. You see how I'm saying here, folks? Marketing and logistics are made a lot more efficient. Okay, so we market to a community. Okay, as well as logistics. If we have people that are contractors or let's say contract services like lawn people, lawn care, laundry services, stuff like that. That's economic to scale. If we have a 200 unit apartment building, they spend all day there, right? Repairs and maintenance costs are more effective as well compared to single family homes. We may have a full-time, depending on the property, we may have a full-time maintenance person on staff that is sitting right there in the complex. So when unit 110 calls, he's there in 10 minutes. Compared to a residential, they're calling your cell phone. You get out of a meeting, you finally get it. Oh yeah, the router's been running for 4 hours. Things like that. Dedicated employees. Again, with the economic scale, the bigger the property, you're able to hire these people on staff. Hiring, let's say, dedicated leasing agents that's there 5 days a week, 6 days a week, 9 to 5, and they're fielding and taking the calls. You're not. Okay. Upgrades, individual units, or common areas can be performed with less impact on the cash flow. Again, let's say you have a couple down units. You fix those. You take those down for a month or 2 months to fix that stuff. You're not impacting a huge cash flow, right? You do that in a single family property, you're at zero. Right? Or if you try to do it with the tenant in there, and I've done that, oh, we're not going to be that long. Well, 6 weeks later, you're still there, and the tenant's just holding back rent and screaming. It's, trust me, that's some of the reasons, the economics of sale. So now that's the biggest one. Now what I said here, and we're getting down towards the end, and I really appreciate you guys staying with me, and I hope this has been of some value to you. I'm going to take you through the life cycle of a project, and then we're going to close things up, okay? And I know I've covered a lot of different topics, and I hope this has been of value to you. And I hope that after this presentation you reach out and we can talk more and fully. But I wanted to cover one last thing here is a typical lifestyle of a project that we use. And again, this is again 5,000 foot level. We do have a written process that we can share with you that goes in more detail. But basically, there's four phases of a multifamily project, right? First is the pre-offer, what we do before we offer on a property, what we do in the next stage, or post-offer. We've already made the offer. What do we do next? And then post-purchase, what do we do after we've purchased the property, right? And then the last stage is sale or refinance. And I'll take you through each one of these real quick, and then we'll wrap it up. So I do appreciate you being with me. So pre-offer, let's look at that. Again, we metro search, we do jobs, we do path of project, we do population growth, rent affordability, income ratios. We run numbers as far as, okay, if our business plan on this property is to raise rents by $25, are the jobs in that area and the income in that area that these people are getting, are we able to do that? Or are they really taxed out at that rate? We look at that as well. We do the team creation of the pre-offer, meaning we talk to brokers and bankers in that area. We talk about project management people in that area as well. Okay, we did inspectors and all that sort of stuff, and forming our team before we even offer on a property. So we get, let's say, market intel from these different companies. So when we do target a property, that we can pretty much know about that property. Then we market to potential opportunities in the target area. We research stabilized size properties or a compatible size in that target area. If we're marketing to 24 to 150, we take a look at all those in the area and see which one would be better, which one would be best for us to target, or which ones, whoa, we don't even want to go on that side of town. Well, then we don't. Then, so we find an opportunity, right? So we do all this and we find an opportunity. Now we do more due diligence and more research on that property, and we do it in a radius of 1 to 10 mile radius on certain criteria like income, population, number of households, number of renters, all that sort of stuff, average rent in those areas, and all those different things. So when we know, when you go to the next step, that we can definitely offer based on actual performance. So we know going into that offer, and again, we get into the offer stage here after we've offered, and we know this is a good property. So we get the post office, or the post offer, I'm sorry. Due diligence begins, and there's several different things in due diligence. We do the property due diligence, and then we do the financial due diligence, and we also take a look again at the comparable due diligence. Now that we've targeted this 150 unit building, how many 150 units in that area? What's that 80 unit property over there? We do a lot of due diligence to compare, because again, we've made an offer. Here's what we're doing, and again, the offer is a negotiation. What we may offer the first shot over the bow may not be the final offer, but when we do more diligence on this, we can come in and say, we can go down to that number or up to that number, Mr. Seller, because we know A, B, and C, and we've got that in our back pocket. And we do post due diligence as well. When we look at that and say, okay, Mr. Seller, we can give you X, but you need to do repair credits, or price or terms, or we can give you that, but you know what, you're gonna have to carry back a second or something like that. Again, I'm going really fast and kind of giving you kind of a real broad overview of kind of the different steps in this. Post offer, the team promotes the opportunity to you, the investors. Once we have it under contract, we then start looking for investor money and we've got the price narrowed down. We've got the buyer where we want them. We get the banker and the financing in place. So we know now that, okay, we go out to the investors with a deal package, a detailed deal package of what this investment opportunity is all like, and we get that to you as soon as we can. Our legal team creates the entities. Our SEC attorney starts getting going, and usually we close within 90 days. Okay, so now post purchase, we've already got the property, right? It's ours. We're all partners in this thing. We're all partners in this 200 unit thing. So what do? We make the changes to the current property management team. Typically, we move out the current property manager and bring in and instill our own property managers, our own processes. We follow the business plan and the unit turn and the business plan we've put together that we've shared with you in the opportunity package, and we institute that day one. Okay, and get things moving and going through this. We do the tenant transitions. We asset management begins, right? This is where we do and review the numbers in more detail. Get in there and get these processes in place. Increase the rents on people who are leaving or coming, and getting new leases in place. Brand new wording in the leases. All that kind of stuff starts taking. Now, you're engaged as the investor, okay? Depending on the amount of turnaround that's needed in the property, we give you monthly updates. And if it's a lot of demo or rehab going, it's we typically break it into 2 week sections, where we're telling you and showing you and giving you webinars and videos of what's going on with your investment. And we've also done property tours as well. We welcome that as well. Investor distributions again are done each quarter, and you receive a percentage based on how much you invested with us, and then we again rinse and repeat, as they say. Now we come to the last step in the life cycle, the sale of the property, right? Management team has done a great job. That's us. Of course we would, right? Up to the 5 years, at the 5 year period, or even before, we look at our opportunities, either refinance or sell the property. If we refinance, obviously distributions would go back to you as the investors. After 5 years and before the property reaches exit strategy, we talk about different things that are going on. And again, going back to the last slide of keeping you involved and in the loop on things, and that's what we pride ourselves on. The communication back to our investors is key, because again, in some of these properties, there may be a very, very huge, big tax event that'll happen if we're going to return $100,000 to you or $200,000 to you. So we're going to give you as much advance notice of that, of our thinking, on before we do that, because obviously we want to make sure it's advantageous for you to do this. You have a place to put the money or shield it from taxes or whatever. Okay. We either places the property for sale or arranges for a refinance, whichever way. And again, we redo the thing. Investors receive their initial investments back along with any profits, and we again rinse and repeat from there. And I know I walked through that pretty quickly, folks, and then again, it's a high level, but it just gives you an idea of what we're doing here, what to expect. What I'd like to do now is kind of do like a real quick recap and then close it down, and we'll rock and roll for tonight. Recap is we learned about the multifamily industry, right? And the reasons and the trends that were driving why investing in multifamily makes sense, and the reasons people should invest in multifamily, that compounding returns aspect of this, of the 6 to 12% or more annualized return that's going to just wallop your stocks, your bonds, your savings account. We learned a little bit about syndication, and again, this was not meant to be a end all with all. This is just to give you a taste of these different things, why multifamily is great, and here how's it done in syndication. If you want more information, you need to contact us and we'll walk you through that. Okay, we learned about a project life cycle. We just took you through that just a minute ago. It kind of gives you a high level overview of what we do in this business on a daily basis. Okay. So, what are we doing? What are we doing right now? Well, we're in buying mode, folks. If you haven't heard, we're in buying mode. We're looking all over the United States. We do have a few states tagged out based on our demographics, and we're looking for partners. Okay, we're looking for partners that have passive money, that want to help us with deals. People, if you need a partner, if you've got an opportunity in your state or your county or where you invest in and you're looking for a partner, give us a call. Let's take a look at it together and see if we can do this. We also will, pay big fat referral fees for properties as well. If you've got something that you can't take down, we'll help you out with that. And if it's our criteria, we'll go ahead with it. And we'll give you nothing would give me more pleasure than to give you a big fat referral fee, and you can see how it changes your life on that end. We're accepting both accredited and non-accredited, as well as sophisticated investors are welcome. Okay, once you qualify. Again, this is just a very digital handshake kind of a thing. There's several other steps that we have to go through to get you into these different investments. And again, we're a few slides off from that, but we are taking both accredited as well as non-accredited investors. And then, so what's the next steps? And we're winding it down here. This is the one of the last slides here. If you want to live the life of your dreams and have the money and take the vacations that you want, now is the time to take action. And take this information you've heard here and go talk to people. Go investigate it more. Call me. Get together with me. Okay, call me and let's chat. Okay, if nothing else, do that. Meet me in person for drinks or for dinner. If you live in the southeastern Michigan area, come up and we'll take it out. We'll go out to dinner or have drinks. You can call me. There's my number there, 734-531-8823. Give me a call and we'll set something up. But if nothing else, folks, go to the website, and it's opportunitycreator.com, and sign up for a newsletter. It's a free newsletter. We do not bombard you. We come out once a month with our newsletter about what's going on, what we're doing. And that's it. We don't bombard you. We're not going to send you salesy stuff. We typically mail once a month. That's what we're doing right now. In fact, we're getting ready to release our next newsletter here in the next day or two. So it's not, don't fear that. So it's on all our pages. You can sign up for the newsletter. It's called, it's on the banner ad there. It says to find out about investment opportunities. Just give us your name and email, and we'll get you on the list.